Hi everyone. I wanted to provide a quick update regarding the collapse of the trade talks between Canada and the United States. Let me walk you through what happened, why it matters, and how it fits into the way we've been positioning portfolios all year. So what happened? For over a year, Canada and the U.S. have been negotiating a renewal of CUSMA, our free trade agreement. Back on July 1st, the U.S. actually declined to extend the deal in its current form, which kicked off a tougher round of talks. Things looked like they were making real progress in recent weeks, but Friday night it all fell apart. The U.S. proposed new terms at the last minute that Prime Minister Carney called unfair and uneconomic. Canada's negotiators came back to Ottawa, and just after midnight, the U.S. followed through on a threat it had been holding over Canada, a 50% tariff on about $20 billion worth of Canadian goods, hitting things like dairy, alcohol, and building materials. Canada's response was quick. Canada will match those tariffs dollar for dollar starting September 8th, targeting sectors like steel, dairy, and electronics. And news reports suggest that we shouldn't expect talks to resume anytime soon. So we should be prepared for this to run for a while. Why it matters? But here's the thing. This shouldn't come as a surprise to anyone who's been following our research. We have been telling this story for over a year now. Back in the summer of last year, we made the call that the drift away from the U.S. was not a temporary blip. It was a durable structural shift. And by the fall of last year, we were already flagging concerns about the increased political influence of U.S. institutions and building a more constructive case for Canada, even while the domestic economy still looked weak on paper. So what does it mean for positioning? How does this fit into what we've been doing in the funds we manage for Canadian investors? A few ways. First, diversification away from the US dollar and US assets. Something we have been doing since the start of this year looks prescient today. We're not scrambling to react to this weekend's news. We've been building in resilience in the event of this kind of scenario. Second, this is a textbook example of the kind of geopolitical shock we've been positioning for with commodities and gold. When trade relationships get disrupted, hard assets tend to hold their value better than promises on paper. And that's exactly the kind of hedge we've leaned into. And third, and this might sound counterintuitive, our view on Canada hasn't changed. The team has argued for months that Canada may be reaching an inflection point. Cyclically well positioned, benefiting from strong commodity demand, and increasingly attractive to global capital precisely because it's diversifying away from the U.S. dependence. A trade dispute is a real near-term headwind, no question, but it doesn't undercut the structural case. If anything, it reinforces why Canada is actively working to reduce that dependence in the first place. Bottom line, this is a genuine escalation and we're watching it closely, but it's not a reason to panic and it's not a reason to abandon the positioning we've had in place. If anything, the last few days are a reminder of why we have positioned these portfolios to be resilient to exactly this kind of shock. Thanks for watching.